hold off on DJing anymore. If you have any more thoughts for us on music, Jam Music is your channel. I suppose we're introducing Jack Sanford here soon, but I'll pass it to our friends Danny, Greg, Julian to kick off.
Hey, give me 1 second and I'll screen share.
Yeah, I was gonna say, Julian, I think you got it.
Can we enable screen sharing?
Indeed. You are now good to go.
Awesome. So to start, I hope that everyone at DevCon is back and healthy-ish, at least. I like a bunch of folks I mean managed to not get COVID, which is great, right? But I've got a bitch of a cold, so hopefully you guys are doing equally as okay. But yeah, so today the goal is to really cover some topics that I mean, generally speaking, are kind of tough to grasp. Last time around, we had Alberto from Yield Protocol to talk about preparing for an audit and a lot of things from the dev point of view. And this time we're trying to get like a bit of more holistic conversation with Jack from Sherlock. So, today, yeah, we'll be talking about risk, insurance, and really the core of that ends up being smart contract audits. So as always, just a quick summary of really what we'll end up doing. We're entering right now. We'll give Jack as much time as he'd really like to go over everything. Feel free to drop questions if someone can get a Slido prepared in the chat and we can pull them from there. And then afterwards, yeah, we'll have some quick breakout sessions as well. Semi-reminder finally as well, the build track, at least on my end, is continuing to be ongoing. We missed last week's session with DevCon, so I think we're picking back up tomorrow with our first one, with that Gabriel will be leading on front end stuff. Obviously, we have one more fireside as well. Next week, we'll be doing likely a little panel. We haven't confirmed all of the guests yet, but just hold bated breath for that. And as always, I think there is, yeah, it looks like there's a Junto today after the session for more like DeFi 101 and just study group stuff as well. So to follow that up, that's kind of, yeah, describing everything I was just talking about. And there's Jack. So I'll kind of end it with that, right? I already introduced Jack and Sherlock a little bit, and I'll let him take it from here.
Cool. Hey guys, how's it going? Good to see all of you. Good to see you, Julian.
Yeah, how's your recovery from DevCon, I guess?
Vivek, everybody. Yeah, it's been fine. Some of our team, we had our whole team down there, and one of them got sick, but everybody else held up all right. Most of us are in Medellin right now, despite the Eiffel Tower in the background here. I'm not sure why that's in the Airbnb, but we're in Medellin, the week after DevCon, just kind of hanging out as a team because it's so crazy during DevCon. So yeah, that's the story here. And was in Kernel Block 2 back in the day. Julian, were you in Kernel Block 2 or were you 1?
I was Block 0 technically, I think it was.
Okay.
Yeah, so I'm the original OG. The original gangster, I guess.
Yeah, I think I remember you being a mentor for Block 2, something like that. But
yeah, we talked. I was trying to get in on your seed round. I think it was something like that.
Yeah, I don't know what happened there. We probably should let you in. Yeah, so I guess happy to talk about whatever you guys want to talk about today. Sherlock, we're a smart contract insurance. So that's kind of like the main thing that we were always trying to fix in the space. Can talk about why we think that's important. We've also moved into auditing because we think that's the best way to underwrite insurance and feel good about it. So happy to talk about that as well. We're doing audit contests, which are like this new thing that we think are really cool and kind of the future of auditing. So all of that I can go into, but yeah, I mean, I have a presentation, I can talk through that, but I would probably rather just answer people's questions if they have questions and kind of, take it where people want to take it.
Let's first get like an overview, right? So explain a little bit more about what the goals of Sherlock really are, right? There's a lot of different ways you can do insurance, right? A lot of people are probably most familiar with what's effectively just like an option, right? Like a binary option or a betting market, almost like Nexus Mutual, or, yeah, you could easily make essentially insurance on something like Poly Market, where you just say, will X protocol be hacked by Y date? And people just bet on them. So yeah, just like tell us a little bit more about Sherlock to begin with, and I suppose how you guys ended up with your initial model.
Yeah, totally. So I guess to give you a little bit of my background, I went to Berkeley, played tennis there, went into like traditional finance, doing investment banking at Morgan Stanley, traded bank stocks at Citadel. That's when I got kind of a good understanding of the financial system. Yeah, go Bears. And then kind of got tired of trading regional bank stocks at Citadel, which, those stocks don't really move that much, and decided to get into coding. So basically quit, learned how to code for like a year and a half, pretty much, did a bunch of different languages, iPhone apps, all that. And then got really into DeFi basically when the pandemic started. We printed a bunch of money in the US. It was called the CARES Act. I think there were a couple follow-ups to it as well. I really didn't like that we did that. I didn't love that we printed a bunch of money to bail out banks in 2008. I thought that wasn't a great, it creates like moral hazard going forward in terms of capitalism and regulation. So happy to talk about that, but had some kind of strong views there. Didn't like that we printed money for the pandemic, and then was like, all right, how do I make sure that the dollar isn't going to get inflated away? And back then there was no inflation. Now there's some inflation, not too crazy though, at least on the dollar.
If you say so. We're at like 10.2% globally, I think, something like that.
Yeah, I mean, some people say that's 10s high. One of our devs here, who I'm actually looking at, Fran, it's 50% in Argentina, so it's a little higher there. But
Sure.
75 now. So yeah, I mean, was kind of scared of that happening to the US and the EU and kind of the world as a whole. And so started looking, that kind of got me into crypto. I basically had the technical background to understand why crypto was cool, had the financial background to know that nothing in the traditional financial world was going to do anything exciting for a very long time. And so crypto and DeFi kind of seemed like the only thing that had a chance of really saving people from, whatever their governments were about to do to them. So that's why I got into it, and then absolutely fell in love with DeFi. It was kind of DeFi summer, that summer that I got into it, before Sherlock was started. And the question I really asked was like, what do we need to get DeFi and crypto to 1 billion users? Like, what is holding us back? And that was in 2020. And basically there were 3 things. It was like the scalability and cost of using a blockchain was not good. So transactions taking too long, costing too much, gas prices too high. That was one thing. I thought there were some good approaches there. Optimism, Arbitrum, obviously those guys were kind of getting started around then. And then the UX side was the second one. Like, if you want 1 billion people and your mother to be able to use crypto, you have to have it be really easy to use from a user experience side. You can't have these big, 32-bit hashes or whatever as people's usernames. So that was a big one. I thought there were some good wallet approaches. I didn't really think that was something that I would be that good at in terms of like designing UX and making it user friendly. And then the third one was really, we need to make sure that people can trust DeFi and they can trust that their money's not going to get stolen. And that was the smart contract risk piece, which, if you want DeFi to get to 1 billion users, you need some kind of assurance that, if I'm putting my life savings into this internet money thing, it's not going to just go away one day and they say, sorry, somebody hacked it. And so that was the piece that I didn't think anyone was really approaching in a good way. And I didn't think I felt good about that problem being solved. So that was the approach that Sherlock decided to take, or I guess the path that Sherlock decided to go down was really.
Were you using insurance protocols at the time and they just kind of sucked? Or yeah, I guess what was like the big problem statement, I suppose?
Yeah, I mean, back then, I think really only Nexus existed. Cover also existed, which is now defunct. But basically, you were like, okay, the covers cost a lot of money. They also aren't very liquid, or the markets aren't very deep. So if you wanted to buy material amount of cover on a protocol, like the price would go up significantly back then on Nexus. And I also thought that if you want to get DeFi to 1 billion users, 1 billion people aren't going to be buying insurance one-off. Like that's not something you see with bank accounts and FDIC insurance. It's not something you see even with Coinbase, where they have insurance on your hot money funds. So I really thought, it's going to be important to bake insurance into protocols and not have it so every single person in the world has to go like buy the insurance and manage it and do all of these difficult things. So that was kind of the problem statement, was there's not an easy way to protect yourself. And also you shouldn't have to protect yourself, as an individual who doesn't know much about crypto, like, your grandmother. So that was Sherlock's approach, was, hey, let's make sure this stuff gets baked into protocols. Let's do it really cheaply. And how do we do it well? So that people aren't getting massive hacks and losing their money, and protocol teams aren't going out of business because they're having hacks. So that was kind of, the audit piece was always sort of in there. We just weren't sure exactly how to do auditing really well. We were hoping other people would do it really well. But yeah, that's the problem statement, to answer your question.
What was, I guess, like the initial thought in terms of how you would do that sort of risk analysis, right? Like, I know you were working, the big thing was you just were like, we're working with Rajiv, he'll figure it out initially, right? Kind of.
Yeah, Rajiv was one of our first advisors, and he had worked at Trail of Bits, and he was like, yeah, some of these audit firms, they're really good. And I guess over the last year, there was a bull market until April or November, whatever it was. And all these audit firms, they hired a bunch of people. Even before that, you never really knew which ones were good and which ones weren't. And you had to kind of rely on reputation, and reputation isn't what gets you a good audit. Reputation isn't what keeps your code safe. It's really like talented individuals hunting really hard for bugs. That's what keeps your code safe. So eventually took a long and winding path of like working with other auditors and then not working with them, and then doing our own audits, and then doing audit contest models to figure out like, okay, this is what we think is the best, most economical way to secure code. And right now that looks like a hybrid between traditional audit, an audit contest, and it's fully done in-house by Sherlock, because we actually care about keeping protocols safe, because if we don't, we pay out a bunch of money.
Yeah, like hopefully the incentives are aligned there, right? Like that's the overall goal, I suppose.
Yeah, exactly.
Yes. So where are you getting your auditors, I suppose, at this point? Like, I guess just more at a high level, explain what you mean by this like hybrid model.
Yeah, totally. So I guess to put it one way, there's traditional audits, which I don't know if everyone in this chat is familiar with, but basically it's 2 people looking at your code for like 2 or 3 weeks. And if you work with a well-known audit firm, then they claim that they have some very smart people like looking at your code for 2 or 3 weeks, and they are going to do their best to find all the bugs in it, but they'll never tell you that they found all the bugs in it. They'll never tell you that your code is safe, all of these things, because it's very difficult to keep protocols safe.
Yeah,
so
I
that's
guess
the traditional.
Before getting too far, that's a specific question that we discussed a lot last cohort was, what is an audit and what should it mean to a protocol, right? And the biggest thing that Alberto is really trying to reinforce was the idea that an audit is not like you can't use it for advertising, right? Like you shouldn't be saying that my protocol is now safe because we're audited. Right. I guess to what degree do you agree with this, and or where on the spectrum can a protocol kind of feel safe like that?
Yeah, so Alberto is correct in so far as the really hard thing about smart contracts is you can never guarantee that one is 100% safe. Like no matter how much time and effort and money you put into it, you can still never guarantee that even the core Uniswap contracts are safe. So that is a really challenging thing, and that is in direct opposition to the billion users who want to actually not lose their life savings and have close to 100% certainty they aren't going to lose their life savings. And then you've got, well, we never know that these contracts are safe. So like those 2 things are always working against each other. You need 100% certainty to put your life savings in. You can never guarantee 100% certainty. The only way to bridge that, in my opinion, is with insurance. Somebody taking the risk and saying, we're moving from 99% to 100%. And if we're wrong, that 1% of the time, we're going to pay for it. And that's kind of how insurance works.
For sure.
But to answer the question, I think, yes, you cannot say that your protocol is 100% safe just because you have an audit. But I think audits in general improve the safety of protocols. So if you're looking at a protocol that doesn't have any audits versus one that does, that's probably some kind of signal. So it's probably like somewhat useful to have the audit stamp or whatever it is. Although there are some really, unfortunately, poor auditors out there where even their stamp doesn't mean much at all.
I'll say pretty directly, we got a CertiK code review, I'd even say, for our first audit. It was cheap, it was useless, and we don't tell anybody about it, right? Because you don't want to advertise that either. But all right. So sorry for interrupting the first question, which was
about that.
yeah, that's the same thing. Guys, avoid CertiK. Don't do it. Just don't do it. But so backing up, the initial question was more just an explanation of the hybrid model, right? Sorry for interrupting that.
Yeah, no worries. So hybrid model, the hybrid is really traditional audit contest. On the traditional side, you guys probably know what that is by now. It's two auditors looking at the code for a few weeks. There's some other things like they do the fix review. That means they're going to tell you a bunch of things that are wrong with the code. And then you're going to be like, okay, those are problems. We agree. We're going to fix those problems. And then you fix them and you're like, hey, but did the new code we wrote to fix the problems, does that have any vulnerabilities? Is that safe? And then the auditor would come back and look at those hopefully small changes and say, yes, we think those are safe. So that's how traditional audit works. It's kind of more complete process. On the audit contest side, it's basically like, here's $100,000. Here's 1,000 lines of code. Whoever finds the most bugs in this 1,000 lines of code gets the most of this $100,000. And anyone in the world can come do this. So that's really cool because instead of having two people looking at the code, you've got 150 is what we have on average. And those 150 people can find a lot more things that can cover a lot more surface area than just two people. And so we've seen from experience in our own protocol and from a lot of protocols we talk to that audit contests tend to catch more bugs than traditional audits. And the whole presentation that I basically have or have given in the past also is that audit contests have never had an actual hack. Like a black hat exploit has never followed and audited a audit contest in terms of the code that was looked at. So that's pretty powerful. Seems like there could be something there. It's still early days, but just if you think about it, that model makes a lot of sense, right? Here's a bunch of people who are highly incentivized to find bugs in code, and they get paid $0 if they find 0 bugs. So they only get paid if they do a good job kind of thing, and they find crazy bugs. So we really like that. Code Arena kind of pioneered that. And it was very raw, kind of rough, where there was no fix review at the end. You didn't know who was going to show up every week. Some week, there's 4 contests and nobody shows up and you don't get the great audit that you're expecting. You get a list of 300 or 500 issues kind of dumped on your desk at the end of the audit. And that's really difficult to kind of deal with as a protocol team. We've experienced that. So we said, okay, this is a really powerful engine, but it's not fully, put into the right place. So let's take the traditional audit and the good parts of that. Let's combine it with the audit contest. And we think that gets you basically what we think is the safest audit or the most secure audit you can get in crypto.
What did you guys do for yourself, I suppose?
Yeah, so we've audited our own contracts with our own process, which is kind of funny. We stayed away from doing that for a while. We had some very top brand name auditors look at our code, and then we had some very big white hat payouts to Immunify because those awesome top auditors missed some bugs that people that we know in our communities found. So that was another impetus of okay, we really need to move to this audit contest model fast, and we have to do it for ourselves as well. And obviously with the insurance backing, we were like, we need to do this for every protocol that we're backing as soon as we can, because it just seems like it's finding way more important bugs than a normal audit.
This is like more, I'm moving more towards the topic of reputation for auditors. And, you know, I've always had thought that there are some incentivization issues with traditional audits, and that there is easily the ability to intentionally overlook a bug and exploit it yourself, just claiming, hey, I missed it, right?
Yeah.
Yeah, for me, like, this is probably one of the bigger advantages of the competition model, is actually this guarantee that, well, if someone finds something, they're kind of forced to report it, or else somebody else will potentially.
Exactly.
So I am a fan, I'll say. It's hilarious that your actual auditors missed a bunch of bugs. I'll also say that we had people report in our audit competitions, essentially white hat bugs on our current deployments as well. Right, so it seems to hopefully attract good people. Well, I don't know for sure. There's also the index hacker that was a Code Arena person. That's like how they caught him. So it's probably goes in both directions. But yeah. So all right, on a more fundamental basis, right? Like, how do you feel that missing bugs actually affects reputation? And or on your end, right? Like, should protocols actually ever be hacked? Does it impact your reputation as an insurer, right? You pay out successfully, so it probably shouldn't. But at the same time, right, you are the ones that kind of have essentially rated the risk too. Yeah, how do you, I suppose, look at the reputation of Sherlock in context of hacks and everything too?
Yeah, totally. So I think, you know, the reputation in general is a pretty like amorphous concept, especially for auditors that have been doing it for years, that have different sort of people and audit teams auditing different protocols, and like every situation is very different. So
yeah,
I think in general, like you know, you've mentioned some audit firms that have hurt their reputation significantly over time. And, you know, that's probably like been somewhat successful in deterring people from using them, but I actually don't think it's been that successful. And not only do people still use them and they still claim they're the best auditor when they reach out to people, you know, they're now backed by Sequoia and Tiger Global. And like, it's actually crazy how the word has not gotten out about that, and the reputation really has not translated into success or failure in terms of these audit firms. So that's really interesting. That kind of shows that reputation is not maybe the best like objective measurement, or it's not really flowing through to results in the way you would hope it would. And so that's why, you know, Sherlock doesn't really rely on reputation. We've relied on, here's an on-chain process where you get paid $10 million if we missed a bug, and Sherlock has no control over that process. And that, you know, we want people to rely on that trustless on-chain sort of claims mechanism versus the reputation of Sherlock that, hey, people say we're good or kind of good, so it's good enough to get an audit from us.
I suppose, how should people rate their auditors, right? Like, in a lot of people's heads, there's Trail of Bits, there's Open Zeppelin, then there's an amorphous blob of everybody else, kind of ish. You know, but realistically, like you were saying, it's going to depend on the auditors that you're individually working with at those firms, if especially there's only two. So how should people really be looking at this and weighing who they go with? Obviously, you guys, right? Like, you're going to be biased, and that's part of the presentation of the entire model. Is, I'm sure, yeah, you can have far more bandwidth, right? But yeah, how should protocols, or especially early stage folks, actually look at establishing their security processes and picking good auditors rather than just somebody?
Yeah, that's a great question. And I'm really not trying to like shill or anything here, but because we had to answer that question as like, people asked us like, how do you know you're underwriting good audits? And how do you know you're not going to pay out $10 million of your staking pool because of Trail of Bits versus Certic or whatever? And we didn't have a good answer to that question, which is the question you just asked me of like, as an early stage protocol, how do you determine which audit firms are good and which ones aren't good and navigate that whole thing? You can't. Like, we were professional navigators and we couldn't figure it out. And so that's why we kind of said, okay, because, you know, for a while it was, all right, if you have a strong reputation, I think it's still a little bit true. You're going to get a higher quality audit. But with the bull market, a bunch of those good audit firms, they hired a bunch of people. We had people with 3 months of experience in crypto auditing our contracts. And it was, you know, things have changed a little bit recently. You used to be able to rely on that more. You can still rely on it a little bit. But I honestly think moving in the direction of like a code arena is good. Sherlock is even better because you get the 10 million behind it. That's the only way you can actually have some kind of, you know, way of assessing if payouts are happening, if bugs are being missed, that kind of thing.
Yeah, I
I
would
guess
even
you-
kind
No.
of comment that like a lot of the times, even if you get a good auditor, it's going to depend on their mood. Literally, like auditing is very much, and this was a lot of the conversation last time with Alberto, is like paying very close attention while you're reading, right? And trying to think abstractly about different ways to execute code. And, you know, a lot of the times folks are not going to be paying as much attention. You know, it's pretty subjective.
Yeah,
so
I mean,
I'm-
if I could comment
yeah,
on that, that's another
yeah.
one of the problems with like the traditional audit firm model is the individual auditors have no incentive to find the extra bug. You know,
Yeah.
they give you a report with 10 issues versus 12, nothing matters, like nothing happens to them. So that's
Yeah.
why audit contests, at least it's like if you show up and you know, take a nap for a week, you don't make any money. So at least
So-
there's like some incentivization there versus the traditional model.
We've been talking about the conversation pretty much from the point of view of the auditor. I'm going to swap that around, right? Like, if you know that you're dealing with, and even in Coterie and when there are incentives, right, it is going to be subjective. If you know you're dealing with essentially just humans that are going to be reading code and getting bored, how do you really, like, how do you deal with this? How do you incentivize auditors to have a good time? And I guess like, just what are some of the big things that everyone should be thinking about pre-audit, or really even just from the start when you're writing your code base? How can you make things easier for these people?
Yeah, so this is the taking it from the protocols perspective, protocol team's perspective, and like how do you approach an audit? There's some really good kind of checklists for this and things that you can do. If someone is getting close to an audit or whatever, happy to like send them that checklist or walk them through the steps a little bit more. But generally, and these are actually requirements for Sherlock audits, but generally you want to have good code commenting. So that's like, if you're using NatSpec, that's even better. Otherwise, just regular, you know, commenting on the code, explaining what's going on. That's super helpful. Having a test suite. So basically they're called unit tests, where you make sure that the code is kind of behaving as expected, or at least testing like the happy path of like, okay, protocol actually works. Because you don't know that your protocol actually works, so you put it on mainnet in a lot of cases. So like, let's try to make sure the normal flows actually work. And so unit tests are really important, and having high test coverage across the code base is really important. Those are probably the two main things. Anything above that, it's getting, you know, security experts will tell you have to do like 10 different things, but if they could tell you 12, they tell you 12, just because you know, they're trying to cover their own, cover themselves. So I think the most important things you can do is just make your code base as clean and understandable as possible, comment it as much as you can, have unit tests on it. That stuff you should probably be doing anyways, just so you can believe that you made a protocol that works. So those are the basics. If you want to get into like fuzzing and things like that, you can do that, but 95% of protocols that we work with don't have time to do that. They're just trying to get straight to the audit and get to mainnet.
So I'll add to this one of the comments that Alberto gave us last time, and I don't know if you've looked at Yield's code base, but essentially they follow the maker naming scheme, where they just name it a bunch of random things. Like their current schemes are like, they've got a witch, they've got a cauldron, and a ladle, right? So
yeah,
the witch is spooning thing. But the point that he was making is that I do agree, is that code bases can kind of tell a story, right? And the more your code base it's well named, is like legible, you know, is obviously well commented, it actually has coverage and everything, the more people actually will audit it, right? I will say confidently that some of Swole's in our previous code base wasn't that, and we got clowned on in our code arena chat. We use 1-letter variable names for like our parameters.
Oh yeah, you guys
And
do that. I
yeah,
forgot about that.
yeah, they're auditing our code base next week, so they're doing fun. But one guy like gave us shit for it, and 20 people, or like 30 auditors, put like an unhappy face as the response to the guy's comment. So like, these things matter. Is all my kind of like final point there, I suppose. Is but
Yeah,
all right,
totally agree. If you're using the MakerDAO scheme, I mean, I'm pretty sure Maker used that so they could make the code less understandable because they didn't want people to like fork it or hack it. That was their,
it's less
2017 kind of
understandable,
mindset.
but more, it's easier to remember. These are the two things I think they're optimizing for.
Yeah.
But all right.
So,
yeah, sorry, go on.
Jack, there's a bunch of great questions, my own questions included, on the Slido.
Perfect.
I could read one question to kick it off if you'd like, and then maybe you can pick and choose.
Through all of them.
Let's do it.
Yeah. So the first one is, how can DeFi insurance cover economic risk? For example, a Terra Luna-esque death spiral.
Yeah, that's a great question. So I take a pretty, I guess, extreme viewpoint here, and I think that there really is no risk-free rate at all. The risk-free rate we think of is treasury yields, and that's basically just the chance that the US is actually going to pay you back. And people just took that for granted for decades and decades, and will probably continue to take it for granted for decades. But at some point, that risk-free rate will turn into an actual risk that the US overextended or whatever. So if you start with the premise that there is no such thing as a risk-free rate, and you get 1% yield on something, you're getting that 1% yield because you're taking a risk. You're getting that 10% yield because you're taking a risk. You're getting 19.6% from Anchor because you're taking a risk. And that is part of what makes the like finance wheel spin. Is some people can sit over here and say, I want to take 0% risk and I just want to have my money and have it again tomorrow. Whereas other people are further out on the risk curve. This is what banks do. Everybody's taking some amount of risk to get yield. And it's 2% or it's 20% or it's 0.05%. But if you start with that premise, then economic risk, like removing economic risk, doesn't really make sense. Because if you are an insurer and you want to remove all of the economic risk, then there's going to be no yield left over for that opportunity, basically. Because if you're getting paid 4% to take that risk, then an insurer would also require 4% to take that risk in an efficient market. So basically, I don't think it necessarily makes sense to cover economic risks, because those are what you get paid for. Happy to explain that more. There's also like CDS, which is a kind of levered twist on this, where you can actually cover economic risks, but you're really levered up. So that's a whole nother thing. But generally, I think economic risks is not something that insurers need to be super focused on, because any risk that you're taking, you should be getting paid the same amount for it that the person who made the initial deposit is getting paid. And therefore they would get 0% after the insurance.
Yeah, just one thought on this is, you could have a Terra Luna where you're getting, say, 20%, but really, if you were to calculate the risk, you should be getting 200% or whatever. I guess that, how can DeFi users, investors know that they're getting compensated for the risk they're taking?
That's a really difficult question. I mean, you can ask that of private equity, you can ask that of VC, you can ask that of everybody. Like, how do you know the yield that you're getting is a good bet or a good trade? And DeFi really democratizes that decision. And so every individual is able to make that decision, for better or worse, of, do I think Anchor at 20% is a good trade or not? And if you're informed really well, maybe you say no and you don't actually put money into Anchor. If you are less informed and you say this is a savings product and wow, it just so happens they're paying me 20%, then maybe you end up on the wrong side of it. So for better or worse, pushes those decisions down to users, which means some users can really make a lot of money and make it for themselves and like do well. And other users will unfortunately, be on the wrong side of those trades and those bets.
Makes
So I'm
sense.
just gonna grab a couple more from the Slido. There's one that I definitely can answer actually, and I don't know if you knew this, but the question is, do you see a world where centralized auditors like PwC, Deloitte, etc., enter the space, likely through acquisitions? If so, when? And the answer is they already have, and they're flip-flopping around and don't know what the fuck they're doing. Like I believe it was chain security question
Yep.
mark. Yeah. Okay. Yeah. You can take the answer then. Go for it.
Yeah, I asked this question too, and I think
Okay.
like I think it's like starting to try to poke at something even deeper. Like I have a hypothesis that assurance and insurance and DeFi are going to be like one of the biggest needs. Assurance more for both for like protocols, right, and then also for investors to make sure that like, hey, it checks these boxes. And I think those services look drastically different. Obviously, an audit for protocols and more like a Morningside, sorry, a Morningstar score
Yeah.
for investments. Morningstar, yeah. I'm sorry, I'm like, yeah. Anyway, and then like, so I see a world where those services are drastically going to mature, and I could see more, maybe an opportunity for more like institutionals like PwC to come in. Sounds like they already have. And then another thing is I'm curious as to like what extent we start to automate and streamline some of these auditing services, so where like human intervention is only really coming down to like the 10% of code that an automation identifies. I'm just curious as like where you think, like what's your thoughts on that? And then two, just like broadly, where do you think assurance from an audit perspective is like headed, given that you sit so so like have such an interesting view on it, or angle is probably the word to say it.
Yeah. So I guess to start at the beginning there, and it was chain security. I can't remember if it was KPMG or PwC that bought them, but it was one of the traditional audit firms bought a crypto audit firm, and didn't really work out that well. I think they might have spun back out. Yeah, they split from
I think
PwC.
it was like
It
only
says in the
like
comment.
6 months or something that they were together, or something like that. I don't know.
Yeah, and I guess like I'm not super well informed on what KPMG does in terms of their auditing, but I'm pretty sure it's like has almost no synergies and no overlap with what auditors in crypto do in terms of like looking at Solidity code and trying to find logic mistakes versus what I assume is looking at accounting practices and making sure that they're compliant with regulatory requirements and different things. I don't think there's a whole lot of overlap between those two things. So I'm not sure it makes sense for normal audit firms to be getting involved with crypto auditing. I think it just so happens that they have the same name, but someone might have a different opinion on that. And then what was the other question in terms of the last one was where is insurance headed, but then there was one in the middle, which I
Yeah,
can't
I'm sorry.
remember.
I did like the worst thing. I gave you a loaded question with like 6 questions in it. So the other
No
one was
worries.
like, what do you think about I guess I asked about automation, but I kind of would rather
Oh
just
yeah,
like,
automation.
what do you think about innovation in this space, and what really helps I guess ensure more, provide like a higher degree and quality of assurance that helps onboard the next billion users, right? I mean, it looks a lot different than what we have today. Probably more of an evolution than like a net new thing, right? Like it's whatever Sherlock grows to be, versus what Sherlock is today. And that's not saying by any means, like Jack, don't take that as like a knock or anything. It's just like you're
No, we're super early.
Yeah, right. We all
The
are,
whole
right?
insurance space is tiny
Yeah.
still.
Yeah. So I guess like what innovations do you see happening in this space that help onboard the next? What do you think is necessary in this space to help onboard the next billion users?
Yeah, I mean, I still think it's broadly along those 3 lines of what I talked about at the beginning, which is scalability. So transactions taking under a second and costing less than 5 cents. Optimism, Arbitrum, Polygon, all these guys are kind of working on that. I think that's headed in a good direction. We're almost there. Obviously, we need to do it without being too centralized, which some people have forgotten about. And then there's like the UX side of it, which is, Vitalik has talked about social recovery, where instead of having to keep this this secret phrase like somewhere in your house and your house burns down or whatever, like instead of having to do that, there's like 5 people in your life who are like a multi-sig that can sign off and say, yes, this person controls this wallet. And as long as you trust those humans, then you get access to your crypto account. That's like a more normal way for people to interact on the UX side than just keeping a passphrase somewhere. So I think that, UX thing needs to be totally fixed. It's obviously improving, and Rainbow Wallet and these guys are doing cool things there, but that has a long way to go. And then the last one is really like the deep security, like making sure the North Koreans can't steal people's life savings from a DeFi protocol. And that's kind of what Sherlock is working on and working towards. Auditors and auditing is helping with that, but because of that dynamic where you can never be 100% sure that smart contract is safe versus people want 100% insurance that they're not going to lose their life savings, you're going to need insurance to bridge that gap, in my opinion. So security and insurance are always going to be sort of hand in hand in the future there. Yeah, I think those are the 3 main things, but I could totally be missing something. There's probably, there needs to be a use case for it as well. So I guess that would be number 4. And there are plenty of countries where I think their currency is messed up enough to where we have a use case in some countries for it, but there's not really like a US use case for it. And I don't know if there will be a US use case in the next, 5 years or something. And I don't think that's bad either. Like if you're serving a few other countries in the world and not necessarily the US, like that's still a pretty successful ecosystem. And eventually other people will say, hey, we want to move to that just in case our government does bad things with the currency. So that would be number 4, is like some sort of use case, which I think is there in some countries, I think is not there in others.
No, I appreciate that's yeah, that all that makes sense to me, especially I like how you started with like 1 and 2, and then 3 is like more the 3 still really critical there. And yeah, use case, all that makes sense to me. Thanks.
Yeah. Jack, I want to just do a couple things. I mean, it's just awesome to see what's happened here. I think the idea was a sound one from the beginning when I first heard you speak about it, but you've gotten to a live working product. It's been only a year or 2. And so the question that is in the Slido that I guess I'm tying it back to is, well, you've gotten to $20 million in coverage. How do you get to 50 billion? But before that, I would love to, because we haven't gotten to spend as much time on just like how has it been to get to here, and maybe just point out like these incentives being aligned and then being able to spend time on it. It's just such a powerful thing, because the idea has always struck me by its simplicity. And then the next step of it is, well, there's a lot of things just to decide to put $20 million to cover $20 million. So I'm just curious how that's been, because I know it's been a journey.
Yeah, definitely. It's been an interesting journey. There was a lot of different kind of ways we went about the auditing side. Like we always knew that would be something. We thought we were going to outsource it and build some kind of incentives there. Then we took it in-house and tried to build incentives there. And then we moved it kind of to where we are now. So there's been an evolution there, but that's always been super core to our mission of like, how do we make sure smart contracts are as safe as possible? And it just took a couple of tries to figure out like, okay, this one is safer than this one, is safer than this one. And so that's been that journey. And then, to get to your question of like, how do we get from 20 million of coverage to 50 billion of coverage? There's really 2 pieces to it. One piece is the protocol side of, protocols need to start valuing it. And that sounds like kind of a weird thing to say, but I think it's already happening. We've seen a lot of protocols where one of their competitors doesn't have smart contract coverage and they do, and they end up getting more deposits, and people just generally feel better about using that protocol because it has the, insurance, which is kind of backed by, hey, we think we did a good job on the audit side, and people just generally feel like that protocol is a bit more de-risked. And that's at the beginning when they first launch and there's 0 and 0 TVL. But even with, protocols like Euler that started out with 0 TVL, now they've got 300 million. We can't cover them for all 300 million, but we still cover them for some amount. And I think, they value that still. People that are using Euler values that still, or value that still. So the protocol side just needs to kind of play out a little bit more. And I don't think you need like too much of a behavioral change from any one party. It's just going to be a continuation of protocols that don't get good audits and don't have insurance get hacked and people lose their money. Protocols that do have good audits and do get the insurance end up, preserving their users' capital more over time. And it'll take time for people to kind of see that play out and the demand for cover to increase at the protocol level. But I think it's inevitable, to be honest. So there's that side of it. And then the other side, which is getting more difficult, is like the capital side of people need to feel good putting capital into this insurance protocol and saying, I want to underwrite these protocols and I feel good about underwriting these protocols. I don't feel like I'm going to lose all my money because these crazy hackers are going to come in and hack these guys and then my money's going to get paid out. So that one is really difficult right now because capital just became a lot more expensive as interest rates have gone up. And so, Sherlock's been struggling with it. Every on-chain insurer has been struggling with it. Even off-chain insurers are struggling with it. Reinsurers are getting a lot more power in the market now in the traditional insurance market, ones that have permanent capital or longer-term capital bases. So to kind of answer that question, protocol side, I think it'll come. And I think it'll just be playing out like protocols that have insurance get hacked less and people trust them more. And so funds flow to those protocols. And then on the kind of insurance capital side, it's just going to be like, okay, where is that capital going to come from? And how do we make sure that they're getting a good deal? And once they see that, Sherlock hasn't had any payouts in the last year, they'll start to feel better about, okay, now there's a year of history, or now there's 2 years of history. And so we feel good about making this investment, putting this capital up, and we feel like we're going to make money on it. So that just is going to take time as well. So I think there's a lot we're doing to try to accelerate those two things, but there's only so much you can do to accelerate them. But I think both of them, as long as you can get the right deal and people feel like they're going to make money, and they've made money historically on the capital provision side, that will come. And then as long as good protocols have better outcomes, or more secure protocols have better outcomes than less secure ones, then it'll come on the protocol side too. So not my favorite answer, because at the end of the day, it's just going to take time, but I think that is what's going to happen.
Yeah, it's helpful though. It's just like here, and it's interesting on the reinsurer side. It makes sense as you describe it, but I haven't put any thought towards that. And I like the answer, for the record. I feel like, as we are exploring those use cases, we're still in this moment in Web3. Like what we spent some time talking about in Kernel is the idea that there are these weirder new forms of money, and we should be experimenting with many different versions of tokens. That's like specifically where we are in the modules this week, module 5. And so these weirder forms of money, they need not all have large TVL volumes right away, but rather could be forms of money that are being explored in small groups that themselves are not taking in large amounts of capital, but at some point could serve as alternatives to the existing systems. And so I'm really, it feels like one of the big things that will take time and should take time.
Yeah, totally agree. I think DeFi is pretty obsessed with like TVL, and not every protocol sees success in terms of TVL, and not every one of these sort of different types of currency is measured in like TVL. So, moving away from that, like Uniswap shouldn't be measured in TVL. It should be measured in like the amount of transactions that happen and the fees that they get from it. And same thing with some of these smaller forms of currency. It's like, what is the actual use case and how much is it helping people? It's not like how much money have people dumped into it.
So I've got a combination of questions here. The first is whether they're like if you had to choose between the two, demand for insurance and or right, like protocols getting audits versus deposits, like which do you see as kind of the chicken or the egg, right? Or really, which comes first?
Yeah.
Yeah, just to start with that, I
That's a great
suppose.
question. That's a great question. It's really hard to know. And I think it's more on the, I would say it's more on the protocol side. Like there
Okay.
has to be the demand from protocols at some point, or people have to see value in it, or investors have to push protocols to be trying to get insurance. Like that successfully happened over the last 5 years with audits, where investors were like, okay, you know what, you just have to get an audit, like use our
Yeah.
money and you just basically have to get an audit with it. And
So
I think, yeah,
extending that then, like if you're able to get a bunch of protocols and the deposits are limited, how many times yeah, how do you guys manage all of those deposits? Do they earn insurance insuring a bunch of protocols at once, or like how many different protocols are they providing insurance to, if that makes sense?
yeah, that's a really interesting question. The fundamental way to start is every insurance thing, even in normal insurance, is over levered, if that makes
Yeah.
sense.
Yeah.
So they take on risk. They could pay out 100 million of risk and they've got 20 million of capital. And so if all those risks go bad at the same time, the insurer is bankrupt. That is a necessary evil of insurance, because if you just do 20 million and 20 million, then the cost of insurance is the same as whatever yield opportunity they're kind of getting. Or it's just not economical. We can go through why it's not economical
Yeah.
in a few different ways, but it's not economical if it's not leveraged in some way. And if you look at traditional insurers, I was talking to a guy who runs like $1 billion P&C insurance operation. They're levered about 40 to 60 times. So if they've got $60 of things they could pay out, they've got $1 that is capital ready to pay that out, which is kind of
this
insane.
like, do you know what you're at?
We're at 2 times.
Okay,
So
wow.
yeah, normal insurers, they're at 40 to 60 times. We're at 2 times. I think we want to be in the 3 to 5 times range. That feels like a conservative range where we can get a good APY to our stakers and have that be enough incentive there. But yeah, I mean, as you diversify risks and go into different areas and whatever, you can continue to increase that sort of leverage.
Cool. It's Greg, was it you that was kind of starting to ask a question? Yeah.
Yeah, I was. There's 2 kind of questions that touch upon this concept of reinsurance, or the need for reinsurance. So one question is, how can a DeFi user feel comfortable that the insurer himself or themselves will not go bankrupt? Is there some type of reinsurance mechanism? And the other question is just, is there reinsurance?
Yeah, that's a really great question. And this is one of the reasons why Sherlock and Nexus Mutual and these others don't call themselves insurance, because that word has special meanings in like the US and Europe, where literally states will use some of their taxpayer money to pay back these insurance companies if they go bankrupt. And so that's like an extra backstop that doesn't exist in DeFi insurance. But I think that's actually okay, because every insurance market that started, like the history of insurance, it was never really backstopped by government funds. And, they've still served a pretty strong purpose and obviously found product market fit and were helpful to people. So it is a little bit more like, make sure you understand that Sherlock is leveraged, 2 to 1. Make sure you understand that Nexus Mutual is leveraged, whatever they are. And so if there were to be multiple events that happen, then everybody might not get 100 cents on the dollar. So yeah, I mean, that's just part of the, I guess, risk premium of paying for insurance as a protocol. It's like, okay, this capital is there. If I'm one of the first people that, has an issue, then that capital will be there for me. But there's a chance in the future, because every insurer is over leveraged, that capital might not be there. And so I have to be willing to take that risk and decide, is that a good risk for me to take? And do I still want to pay those premiums? Or is that something I'm not comfortable with, and then I'm not going to use DeFi insurance? So it's just a little bit different mindset, I guess, there. And then on the topic of reinsurance broadly, this is going to be an interesting one. We actually have an announcement coming out tomorrow about this. So keep an eye out for potentially the first reinsurance ever in crypto, which could be cool. But yeah, for us, we're trying to figure out, is on-chain reinsurance the way to go, or is off-chain the way to go? On-chain, we think of as being a lot better because it has the permissionless properties of DeFi that we like, that protocols like, that people are more comfortable with. You can see the path and the code of like how these things will happen. Off-chain insurance has the advantage of having multiple trillions of dollars that they can use for insurance and reinsurance versus about 250 million in DeFi right now. So, that's a pretty big difference. And it does make a lot of people and Sherlock itself think about like, how could we incorporate some of that capital? I think if we were to do it, we would do some kind of hybrid model where it's like, all right, we've got, 50 million on chain, and you're going to get paid out by that 50 million, and it's programmatic and all of that. And then, a trillion off chain, where if something happens to that 50 million, some of that gets transferred on chain, and then it like re-ups, and you can always see that you have something on chain that's going to get paid out based on more programmatic criteria than the rules of, Germany, where Munich Re is, or the legal system of Germany is going to decide. We don't like that, but unfortunately, they have trillions of dollars, and we have very few in the bear market. So we'll see how it plays out. It's not totally in Sherlock's hands. We'll have to see what others kind of do as well there, and what we have to stay competitive with, but we want to keep it as on-chain, decentralized as possible.
Yeah. And on that, I could be completely wrong, but when I looked at Nexus a while back, it seemed like, even though it was Web3 based insurance, it was a very subjective kind of payout. Like, there's going to be a DAO vote to see who gets paid out type of thing. It seems crazy subjective. Are you guys thinking about it in a different way? Like how does that payout or eventually work?
Yes. So that was one of the key things that I didn't like about Nexus back when I was starting Sherlock. And so we tried to come up with a better way of doing that. The problem with Nexus is that NXM token holders are the ones who decide on payouts, and NXM token holders are the ones who get hurt if a payout happens. Like, it's their capital that's coming out. So you can see that there might be a pretty strong sort of bias there. Sherlock basically tried to solve this by creating a less biased claims mechanism. And there's this whole kind of discussion around programmatic claims, where you just have these on-chain triggers that automatically pay stuff out. I really don't think those are the future. There's some insurers, on-chain sort of things, that have raised a lot of money trying that approach. None of them have been successful. I don't think that is the future, and we can talk about why. And so we still have to have humans involved, is the upshot of that. And so the way we do it is we have a committee, a multi-sig, 4 of 7 multi-sig of some well-known security experts in the space. They can make a really quick decision about it, but they might be biased, or someone might pay them off. So we have that as like the quick, easy thing. And then if the protocol doesn't like the answer that this 4 of 7 multi-sig gives, they can pay some extra money and escalate it to the UMA optimistic oracle, which is like, we can talk about, this is a whole nother thing, and it's really interesting, but the simple way to say it is, it's like UMA's market cap, let's call it 500 million right now. So it's $500 million of UMA token holders voting on whether a claim should get paid out or not. And UMA has nothing to do with Sherlock. So they're unbiased. They probably have nothing to do with the protocol in question too. So totally unbiased, hopefully, but they can be paid off in certain ways. But in order to like pay these people off or buy UMA tokens to do the voting yourself, you have to pay significantly more than the value of the claim, at least for now. We'll see when Sherlock, coverages get bigger and UMA doesn't get bigger, like that will cause some issues. But for now, there's like a massive buffer there that we feel pretty good about, in terms of, it would cost way more to bribe UMA token holders than it would to, it would cost way more than the value of the payout. So it doesn't make economic sense to try to commit sort of like fraud in that way. But basically, we've taken sort of what Nexus is doing, except had a totally unrelated DAO vote on the payout at the very end.
Cool. So we're essentially at time. I'm gonna ask one question that I think is important, which is, for projects that are early stage, are looking for essentially code reviews or just to like up their security, but essentially either can't afford or haven't validated an audit, right? Like, where should they be going, and or like, what can they do to make their contracts a little safer?
Yeah, I mean, unfortunately, I can't recommend a protocol try to do a crazy $100 million launch without getting audits. Like, there's just not enough that you can do in terms of like self-securing or running fuzzers or running Slither or doing some of these things that are great practices, best practices maybe, but they don't get you to the level of security that you probably need for $100 million of TVL. So I think for those protocols, they just need to, I mean, it's hard enough to get $100 million of TVL as a protocol. So that might be a constraint for them anyways, but potentially have some kind of cap on the launch. If they really are sure they're going to get 100 million and they're like, all right, we want to cap it at like 500K or something that we're more comfortable with. And if there were to be a hack, it's at your own risk. If there's a hack on this, then that money's gone, and you make that very clear to users that it's a beta and it's just testing out, product market fit for other means. And it's not the final sort of secured version, not secured, but more secured version that you would get after audits. So my advice to those protocols that can't afford audits would just be test out your product market fit in any way that you can. And then if you do that well in a small scale, you can either raise money through your token or through VCs or whatever to be able to afford audits, and then do it on a larger scale afterwards.
Awesome. So yeah, I guess we can kind of end there. People can feel free to stick around. Jack, you're in the Slack, so I won't volunteer you. I don't know how much you're gonna be around, but feel free, I suppose, in general, to kind of accumulate questions, and we can try to send those by.
Sure.
And or yeah, we'll be heading over to the breakout sessions. So let me drop the link for anyone that doesn't have it. Town.
I see one last question from Greg on the auditor tiers. Probably best if I don't have to answer that. So I'll just assume we ran out of time.
We can end the recording at the least, but yeah, we can.
Yeah. I think maybe we can just ask Julian that, and Julian